Hi, this is Shara Gregory with Plan to Profit in Real Estate. And in this video, I'm going to show you how to use the Excel file that I put together for analyzing potential rental properties. You can see that the spreadsheet has several different sections, and I'm going to be going over these one at a time rather than trying to just show you the entire spreadsheet all together, which could be a little bit overwhelming. But by the time we're finished with this, you'll understand how to use this worksheet to estimate the cash flow for your potential rental properties. I'm assuming that you're familiar with the various components of cash flow, and if you'd like to review that information, there's another video on that topic that you can watch. Along the same lines, I'm also not going to go into a lot of detail on what's behind short-term and long-term funding, but we will be working with that information in the analysis of the deal. So if you want to review how short-term and long-term funding can be used, in particular with the BRRRR method of buying long-term buy and hold properties, then you can also review the video on that topic as well. But for the analysis, we're just going to be focusing on how we use those numbers in the spreadsheet to determine your long-term cash flow, or at least give you an estimate of what that may be for a particular property. So let's start with the first section on the purchase of the property itself. And this is where we're going to start entering some data in the spreadsheet. Anywhere that you see a slightly shaded color field or cell, that is where you do enter data. The ones that are just plain white are formulas, and you don't want to enter any information there. So I recommend making a copy of the file, saving it under a different name somewhere, so that if you ever do need to recover the entire file with all the original formulas, you'll be able to do that. In this example, we're going to say that we're purchasing a property for $76,500 and that our rehab cost is going to be about $32,000. Now, for the first pass on looking at funding, I'm going to be assuming that you're doing your long-term funding right here at the time of the initial purchase. So the closing costs that you would enter would be including anything that your lender might want for their your long-term funding. And the last number you want to enter in this section is your estimated after repair value. We're going to say $135,000. This should be based on some comps that you've pulled, or somebody that you trust has pulled the information for you to know that this is, after you've done your rehab, approximately what that value could be. For your long-term funding, this is important because this would also be what you would expect the appraised value to be, and your lender is going to be working off of that number. So now when we go to the long-term funding, the first thing we want to figure out is how much are you trying to borrow? So the way the spreadsheet works is the various components of the cost of your project are listed here, and you can decide whether or not to include those in your long-term loan amount by putting either a 1 or a 0 here in this column. So for example, if you didn't want to try to include those closing costs in your long-term loan, you would just put a 0 instead of a 1, and now the total value for your long-term loan that's shown here and copied into this amount to borrow field is just the amount of the purchase and the rehab. Now, this is the amount that you would begin with thinking you wanted to borrow. However, your lender might not be willing to lend you 100% of the purchase and rehab costs. So there is a percent from cash that you have to put down in that case. And let's say they were going to require 10%. So you'd put 10% as your down payment, which works out to be this much cash you have to bring to the table, resulting in this loan amount. Now, I will say, because we already covered the closing costs in the initial purchase, you can just ignore this row talking about refinance closing costs. We'll use that later on when we're talking about your long-term funding being a refinance. But in this case, we're just saying that from the beginning of the loan, you're going to be getting a loan for this much, you're bringing this much to the table, and now for your analysis, you need to know approximately what your interest rate is going to be and how many years amortization you're looking at, whether it's a a 10-year or 15-year loan, a 30-year loan, something like that. So let's say you could get a 5% loan at 30 years. And so now you can see the calculation here shows you what your monthly mortgage payment would be, and then just times 12 is the annual amount. For this loan, you may wind up having to pay private mortgage insurance, that's PMI. So if that's the case, then you'd want to have an estimate of that from your lender, and you could put in a number here. Let's say, for example, it might be $120 a month as PMI. So if you enter that value here, then it gets added into your monthly mortgage payment, which is now going to cover your principal, interest, and your PMI. For the rest of this video, we're going to look at the situation where you're using both short-term and long-term funding. So in that case, we want to look first here at the short-term funding section, and this is where you can say yes or no. Are you using short-term funding? So in this case, we want to switch this to a yes. And now from this point forward, we're going to be talking about calculations related to both a short-term time period, could be just a few months, it could be 8 months, it could be a full year, but in essence, it's not the funding that you'll use for the entire length of time that you own the property. This is basically what it takes to get the thing up and running, and then ultimately you wind up refinancing with some type of long-term lender, generally a bank, but it could be some other source of funds as well. So again, we also want to look at how much do we need to borrow in order to purchase the property and cover those initial costs. Now, because this, in this example now, our initial closing cost might be a little bit lower if we're working with a private money or a hard money lender versus that bank that we were talking about in the long-term loan. But again, you need to do an estimate what you think your closing costs are going to be, but maybe we do want to try to cover those costs in the long run. So we put a 1 there. Now, generally, your short-term lender may or may not be willing to lend you the full amount that it's going to take to do this project. Let's say, for example, that they will lend a portion, but you also need to have some skin in the game. You want to bring some money to the project itself. So we're going to say that you're putting in $18,000, and that's your own funds. So since you're putting in $18,000, then the amount that you need to borrow from your short-term lender is $92,000. The difference between your total cost and the amount you're putting in is the amount that you need to borrow. With the amount that you've put in, you may actually have to pay some money to use those funds. For example, if you're using a home equity line of credit, you might have an interest rate that you have to pay to your bank. So we want to look at that as a cost of this project as well. So let's say that you have to pay 6% on your HELOC funds, and that you're planning to use that money for a total of 6 months of the short-term lending period. And that comes up to $540. That's the cost of using your own funds. Now, for your borrowed funds, you'll have some terms that you've negotiated with your short-term lender, and we're going to say that's 11% and 2 points. And then you need to say how long do you expect this short-term time frame to be. In this example, we're going to say 8 months is the full time frame for the short-term loan, and you can see that that's different from the amount of time that we were planning to need to use our own funds. So you do have the flexibility to put a different time frame on the amount of time that you're going to use your own money versus the amount of time that you're going to need the short-term money. So this 8 months in our example here is the amount of time that we think it's going to take before we would have a refinance in place and completed in order to pay off that $92,000 to our hard money lender or private money lender, whoever it is that provided the short-term funding. So now when we want to look at what that refinance is going to be, we're going to come down here and say, okay, there's some amount of money that we want to borrow for the refinance. But you have the ability to include or not include various portions of your total cost in your long-term loan. Right now, the way we have this set up is it's showing your total acquisition cost is the entire amount of what it costs you to purchase, rehab, pay your closing costs, and pay your own cost of funds and the amount that you're going to have to pay to your short-term lender. That's your total acquisition cost. If that is the full amount that you want to try to borrow, which is kind of the ultimate BRRRR strategy, is that you're able to repay all aspects of the cost of getting into the deal, then you would leave this as your amount to borrow for your long-term funding. You will have some refinance closing costs that you need to cover there, because you're doing a second closing that 8 months down the line when you're going to do your refinance. So let's say in this case it's another $1,500. So actually you might want to borrow even just a little bit more if you literally want to cover every bit of money that you would have put into this deal. Now your bank may or may not be willing to lend you that full amount. This is where some of the ratios come into play, and we'll talk about those a little bit later on. If you have a couple of options here to reduce that amount if needed. One easy way to do that is if you decided to leave your own funds in the deal, this $18,000 that you had put in to begin with. You see there's a little note here saying that if you put a -1 here, it will reduce the amount of the loan that you need. Again, this is $18,000 that you've already spent. You've already put it into the deal. So you're just saying you're not trying to recover that. In effect, you're kind of going to let it ride in the deal. So if you put a -1 here, then that's going to reduce the total amount that you're looking to borrow for your refinance with your long-term funding. You should have an idea right at this point when you're doing your analysis of this potential rental property of what your interest rate and amortization is going to look like. Of course, that could change by the time you get to actually doing the refinance, but you need to have some idea at this point so that you can do this analysis. So in this case, we're going to say that we're going to be able to get a 4.5% loan that's amortized over 20 years. So you know that that's a more like a commercial loan. And with that type of loan, we wouldn't really be talking about PMI. So our monthly mortgage payment is shown here. And again, that's multiplied out to give us an annual number. So that's it for the long-term and short-term funding section of the spreadsheet. Now we want to look at our income. So based on your analysis of the area, the comparable rents in the area, you've determined that the monthly rent is $1,200. That's the amount that you feel you'll be able to get for this property. And the other thing you want to consider, especially when you're looking at what is going to happen during these first few months of your project, is how many months is this property going to be vacant at the beginning? If you don't have inherited tenants, you're doing this $32,000 rehab, so chances are the property's going to be vacant during that initial time frame. So there's going to be some period of time when you don't have rent coming in. And in this case, we're going to say 2 months. It doesn't have to be a whole number. You could enter 1.5. But basically you want to take into account the fact that you're not receiving rent for the period of time that you're doing the rehab and the time that it takes to do the marketing, show the property, agree on who's going to be your first tenant in the property. If you did have an inherited tenant and you're just taking over the rent from the beginning, then you could put 0 here, but you probably wouldn't have as large a rehab in that situation. So now within the revenue section, we're looking at 2 numbers. We want to know what is our gross income during the short-term time frame. So that's calculated here. Remember, we said the full amount of the short-term was going to be 8 months, but those first 2 months we're not getting rent. So this short-term gross income is the monthly rent times the 6 months that we actually expect to be collecting rent during the short term. Then when we look at the long-term income, we have the starting point, which is our monthly rent times 12. But then you want to subtract out some vacancy factor. 8% is a fairly conservative number because that works out to be approximately 1 month a year that the property would be vacant. Now, sometimes if it does go vacant, it may take you longer than a month to turn it over. So over time, that could be your actual vacancy rate, but you want to at least have some number here to take into account the fact that you will have turnovers when you, in the long run, when you hold a property for a long enough period of time. You might decide, for example, that 8% is the number you want to work with. You can talk to property managers and other people in your local market to determine what you think a good vacancy rate would be. Main thing is you don't want it to be 0. Now we're going to look at the expenses for the property. In this section, all of these numbers should be annual numbers. So we're going to start with looking at the annual property taxes, and that's based on the assessed value. So we're assuming in this case that this property is currently assessed for $99,000 and that the local city or county tax rate is 1.2. That means that they are collecting $1.2 for every $100 of assessed value. So the calculation shows you here what the annual tax rate will be. Then you want to put in an estimate for your annual insurance. I think it's a good idea to include some number for anticipated repairs. These are just the minor things that can happen. If you have to call in a plumber or an electrician, something kind of odd happens. This is not high ticket items. These are just things that happen. If you do have an HOA, you can put that number here. If you are taking responsibility to pay certain utilities like water, for example, then you would want to put that here. Just remember this is an annual number. Also, if you had any other type of expense that you can think of that you know would be in place year in and year out, maybe you're paying for lawn maintenance, for example, something like that, you would use these fields for that, use this field other for that. So what you have now is a total of your anticipated annual long-term expenses. Because we put these as an annual number, this is what you would expect it to be over a 12-month period each year. So this is your long-term number. But we also want to estimate what these expenses are going to be during our short-term time frame right there at the beginning, those first 8 months. So this is just a calculation of your short-term expenses, which is just 8 months worth of your annual expenses, because we said this short term in this example is only 8 months. The last thing that we want to include in our expense calculation is some type of set aside for capital reserves. These are the big ticket items like roof, heat pump, that sort of thing, that if you hold a property long enough, you will need to pay. Even if you do a full rehab, replacing those items at the beginning, if you hold the property for 15 years, 20 years, 30 years, at some point you will have to replace those items. So you want to take that into account in your capital expense reserves. Again, I go into much more detail on that in the video on cash flow. In this example, we're going to use $1,800 per year as our set-asides for capital expenses. So at this point, you've entered almost all the numbers you need to do a determination of cash flow. We're going to start with looking at the cash flow, assuming that you're not using a property manager. The starting point is determining your net operating income. So this is based on the values that you've already determined for gross income and expenses. We're looking at these numbers both for the short-term time period, which in this example we said was going to be 8 months, and your long-term, which we will always put on an annualized basis, so a 12-month period. The gross income and the expenses we already looked at for both short-term and long-term, and it's just a matter of pulling those over into the net operating income section as you see here. So you just take the gross income minus your expenses, again, numbers that you've already determined, subtract that, and you come up with your net operating income. So now for cash flow, we're just taking that net operating income bringing it down as our starting point for cash flow, and all we're doing is subtracting the funding costs that we had already determined. So you can see where we're pulling in our total funding cost from the short-term section and our annual mortgage payment from the long-term funding section. So we take our net operating income minus the funding cost to determine the cash flow for the period. For the short-term time frame, that's the cash flow over our 8-month period, and for the long term, it is our annual cash flow. So then to determine the monthly cash flow, in the short term, we're just dividing it by our 8 months, and for the long term, we're dividing that by 12. And you see the result is, for the long term, $150 per month. Now, if your goal had been, for example, $200 a month in cash flow, you would look at that and say, well, maybe not on this property. There may be some things you can do to get to your $200 cash flow number, and we'll talk about that in a minute. But the main thing is that the first pass on this that you see is that with these initial numbers that you've entered, it does not meet a cash flow target of $200 a month. So when you look at what your options are, the temptation is to just say, oh, well, I'll just make the monthly rent higher. I bet I could probably get $1,250. So you bump it up to $1,250, and now with a little bit of vacancy, you're really close to your $200 number. But remember, when you put that $1,200 in to begin with, that was supposed to be your true estimate of what you really thought you could get for rents for this property. So don't go back and change numbers just because you don't like the result that you got. It's a good idea to be realistic here. This is what you're doing with your analysis, is letting this tell you whether or not you're going to meet your cash flow target. However, there are still some things you can do. Remember, over here on the borrowing side, we tried to borrow the most of the money that had been put into the short-term funding. We were leaving the $18,000 in place that was used from our own funds at the beginning. But you do have the option here to come in and say, okay, I'm going to put a little more cash into the deal by way of borrowing less when I do the refinance. So you can play with that number a little bit, but I know if I put 8% down, so I'm only borrowing $94,400 instead of that original $102, then that does get me up to my cash flow target of $202. Now, the total cash invested, though, is going up higher, right? Because I've put in now an amount here by, in effect, not covering all of my costs. So this total cash invested is a number that takes into account all the different places here where we've said that we're putting our own cash in. It's our own funds that we didn't try to refinance out. It's the cash that we put in here when we said we're not going to take out as much of a refinance as we might otherwise have tried to get. And it's also this negative amount of cash flow that we encountered during the short-term period, the amount of our costs that were not covered by the rent that we were collecting during the short-term period. So that comes up to almost $30,000 of our own money in the deal. And so you can see in the long term, our long-term cash flow gives us an ROI, cash on cash return, of about 8.2%. So again, you make your own determination of what your goals are for cash flow, however you want to measure that, whether it's cash on cash return or a monthly return, and you decide if this is going to meet your criteria. The next section we want to look at is what happens if you decide that you do want to use property management. And one of the things I know the BiggerPockets guys harp on all the time, and I definitely agree with, is they say your analysis of your rental property should show that you will have a positive cash flow even if you use property management even if you're not planning to use property management at the start, because things can change. You may decide eventually that you want to use a property manager, and if you've got a property that will only cash flow by you doing all of that work, then you're kind of locked in and you really don't have the option to use a property manager. Or you may even have a goal of your cash flow target being in place with using property management from the beginning. So again, you can use this to see if this deal is going to meet your criteria. So to do that, the first thing we need to do is look at an estimate of the cost of property management. In this case, with property managers, you're usually going to have two different main fees. One is going to be a percentage of the total of the monthly rent that they take out every month, and then the other is a fee for tenant placement. And that's usually some percentage of the rent. It could be 50%, 75%, or even 100% of 1 month's rent to do a tenant placement. And so based on talking with property managers in your area or knowing who you want to work with, you should have some idea of what these numbers are, and you can fill those in here. For your initial placement, you have the opportunity to say yes or no. Are you going to use a property manager when you do your short-term rental? So if you are, then that's another expense that's going to need to be paid during the short-term time period. The other thing that you want to do is come up with some estimate of your anticipated average number of years per tenant. Because you don't want to build in an assumption that you're going to be paying for a new tenant placement every year. If that's the case, then you need to get a different property manager. So in this example, we're just saying 3 years. So our tenant placement fee would on average be encountered every 3 years. Now again, this is not, we're not running out this analysis over time to take into account inflation, rental increases, that sort of thing. We're really looking at a snapshot, but overall you want to say that this fee would really only be encountered every 3 years. So this gives you a total for your property management cost. So to come up with the cash flow estimate with property management, now what you're doing is going back and saying, okay, we had a certain amount of cash flow that we were estimating without doing any property management. We've just estimated what our property management cost will be during these two time frames, short-term and long-term. And so by just subtracting that number from our estimate of cash flow without property management, we can determine an estimate for the cash flow with property management. And then again, as before, take that and divide it by the time frame to be able to come up with the estimate of the monthly cash flow. The last section we're going to cover are the ratios. So the first ratio you see here is the total acquisition cost divided by the after repair value. And this is an indication of the amount of equity that you're able to achieve in the property right from the beginning. The next ratio is your amount of your long-term loan divided by the after repair value. This is the loan to value ratio that your long-term lender will be looking at. In this example, you see it's 70%. It could be that if you have a lender that said they were willing to lend up to 80%, then maybe you could have borrowed more. But remember, we trimmed it back because of our monthly cash flow target. So this doesn't mean that you have to borrow as much as what the lender says they would go to, but you definitely want to know if the lender, for example, had said they would only do 65% loan to value, then in that case you won't be able to borrow this much because this works out to be 70%. The cap rate is a measure of return on investment that some investors like to use. It's the net operating income divided by the total acquisition cost. And then we also have the rent. This is the monthly rent divided by the total amount for the purchase and rehab. This is what you hear about when people talk about the 1% rule. And what they're saying there is that the total monthly rent should be at least 1% of the total cost of the purchase and rehab. That doesn't mean that just because something has a 1% value of rent to purchase and rehab cost that it will meet your cash flow targets. I think a better way to look at it is to say if it's not at least 1%, then it's very unlikely that it's going to meet your cash flow targets. But again, that's a number that you see calculated here as for a piece of information. The final section is the debt coverage ratio, and this is something that your commercial lender is likely to use if you do your long-term financing with a commercial lender. So for the debt coverage ratio, you're looking at your income that's coming in from rent after your expenses, so that's your net operating income, and using that money to pay for your mortgage. So they want to see that the amount of money that you have coming in after you've paid your expenses well exceeds the amount of money that you need to pay the bank or whoever your long-term lender is for that loan, for that mortgage. So the way it's calculated is you just take your net operating income, not taking out that set aside that we did for the capital expenditures, but just taking out the sort of routine expenses. That's your net operating income. And then you also look at your annual mortgage payments. So you take the net operating income divided by the annual mortgage amount, and that gives you your debt coverage ratio. In this example, it's almost 1.6, which is a pretty strong debt coverage ratio. Lenders will generally tell you what their minimum requirements are. It might be 1.2, 1.4, something like that. But that's a number that you want to know when you're planning your long-term refinance and when you're analyzing a rental. So a really important aspect of this is whether or not you have a history as a landlord to be able to show to that long-term lender for your refinance. Because if you don't have rental income on your tax returns to be able to show them, then for them to be a little bit conservative on their lending practices, they may not want to account 100% of the rental income towards the debt coverage ratio. So that's why you see this question here, do you have a tax return with rental income? So if you say no, then there's a lower percentage of your rental income that's going to be counting toward your money that you can use to pay that debt or for the debt coverage ratio calculation. This formula assumes that lower number is going to be 75%. If you know that you won't be able to show rental income and your lender has a different number, then you can just fill that in here. But in this case, by having to drop it to 75%, now we have much lower amount of net operating income to cover the total amount of the annual mortgage payments. So you can see that our debt coverage ratio is only 1.1. So in that case, your lender may not be willing to lend the full amount that you're looking for this property. And that in itself might be a deal breaker, even if it makes your cash flow targets. If it doesn't look like you're going to be able to get the refinance that you want or need at the end, then that's also information that you want to have before you buy. So that's why it's included here in your analysis of a potential rental property. So I hope that you have a better feel now for how to use this entire spreadsheet for doing your analysis of potential rentals. I would just say as kind of a final caution, one of the things that's very tempting to do is to start tweaking the numbers to make a deal look better. And the main thing is just to continue to work with realistic numbers, because the reality will hit. So if you tweak something to try to make it fit, you may regret that later. The other thing that can happen is you can use the spreadsheet to create a unicorn. So what I mean by that is you could use the spreadsheet to say, what do you want to find as a rental property? So I only want to pay $50,000 and I only want to put $10,000 rehab into it, and it will rent for $1,100 a month. And hey, look at that cash flow. Well, yeah, that's great. You can do that. But then you may spend the next 3 years trying to find that property. I think it's a much better way to use the spreadsheet and learn your market, is to look at actual deals and then run the numbers on them. Even if it's a deal that you don't think you want to buy, that's a great one to just run numbers on to get a good feel for how it plays out when you look at this all together. You want to practice on analyzing deals so that you can recognize the good ones when they come along. So good luck with that. Thank you.